All right. Well, there is my good friend Brian Stickney. I've known also Brian for about a decade. And he actually was just recently near my town. He was in Pensacola, Florida, and we tried to hook up, but I caught a cold. Some call it something else, but I caught a cold, and so I couldn't go meet with Brian and his family. But that's who he is. This guy, he's a great guy. Love his kid, love his wife, and he literally his make money from your laptop.com. Brian and I have known each other for 10 years, and that's all he does is travel the world with money he makes from trading. Brian, why don't you go ahead and mic up and video up? Today's going to be talking about, and I've seen this presentation, and it's very much like Silas in that it's going to be very simple for you to follow. It's going to make sense, and you should be able to take it and apply it to what you're doing right now. Whether you join services or buy stuff, the goal here is for you to take this education and be able to take at least just one little nugget from what you hear from these traders and apply it to what you're doing. I see your PowerPoint, Brian.
Cool. Very good. You hear me all right?
I can hear, maybe turn it up just a little bit.
Maybe I can get closer to my face. How's that?
Closer to your face, okay.
I don't know how to turn it up, but I can put it closer to my face.
Outstanding.
A little, maybe it's me because I've got mine down. Does it sound good to you, Raleigh?
Yeah, sounds great to me. See you loud and clear, hear you loud and clear. Looking forward to your presentation, Brian.
Awesome. Well, thank you very, very much for that. I'm really happy to be here, guys. For everyone that's on right now, thank you for attending today's training. There's as you've already seen, if you've been here for the day, there's a lot of great speakers that have been here today, a lot coming up for the remainder of the 2 days as well. So, be sure to stay around and catch them all, right? Kind of like Pokemon, catch them all. Everyone that's speaking at this event has a very unique take on the market and a unique way of trading. And I'd certainly love events like this, like Jeanette just said, and Raleigh has said, have already pointed out. These are great for ways to get different ideas, for ways to trade, find methods, maybe even combinations of methods that are going to best suit you and your trading style. So, with that said, please keep in mind that there's no magic bullet. I'm sure that you've already heard that today, but I'm just going to reiterate it. There's no magic bullet. There's no, quote, best way to trade. The best trading method is the one that gives you an edge and that you can execute consistently time and time again, right? That's what it's all about. Just because one person does something in a different way from someone else, it doesn't mean that one is right and the other is wrong. They just have different ways of approaching the market. Different approaches work for different people. And that's why I love events like this. It's great to get exposed to those different ways of trading and see how things look. So much to learn. Anyway, also to put you at ease, as Jeanette said, I want you to focus on what I'm teaching today. I'm going to be teaching something that is 100% actionable when you leave here. You can start applying it immediately. Now I have tools that I use that make what I do a little bit easier, but everything I'm going to teach, you've got indicators built in by default into your trading platform to make this work, okay? So at the end of the session, I'm going to give you an opportunity to get those tools that I use and learn more from me if you want to. So, I hope that sounds good to everyone. So if it does, great. I'm going to minimize the chat right now because I need to focus on the presentation, and quite honest with you, I'll get to your questions at the end, but I don't want you to think I'm ignoring you. I just simply can't present and read comments at the same time. If I do, I start tripping all over myself, and we don't want that. So what I'm going to talk to you about today is a super simple trading method that'll help you time your trades a little bit better and stack the odds in your favor when you're trading. And that's what we're all looking for, right? We're all looking for a simple way to get an edge on the market. Now, why isn't this slide progressing? Let's see here. There we go. Now, the title for the segment here is 3 Simple Steps That Can Change Your Future. I am all about simple. After years in this game, I've found out, for me anyway, that the simple strategies were easier to follow and therefore much more effective for me. Now, I trade in multiple markets, as I'm sure many of you do that are here today. My focus is in Forex and futures, but I do sprinkle in a little bit of crypto here and there for some flavor. When I'm trading, I am particularly fond of trading in the direction of the trend. So what we're going to teach you about today is basically some trend trading opportunities, and I'm going to show you the basics of how I exploit my edge in the market and how you can start doing the same. Now, I know you've heard it before. You've heard it multiple times already today. The 3 steps to success, the 5 moves for massive wealth, the 7 things you've got to know before you do X, Y, and Z. Everyone's all about lists, right? There's always more to it. So I'm going to show you in truly 3 simple steps how you can find great entry points that give you an edge. Is there more to it? Yeah, of course, there's more to it. But the 3 simple steps that I'm going to talk about will give you an advantage to easily finding great trend following entries. So if you're interested in getting that edge, let's keep things moving here. Now, obviously, before I begin, I'm always compelled, as is everyone, to put up a disclaimer. It's very important that I point out I'm just a guy on the internet. I'm not a licensed investment advisor. I don't play one on TV. I don't pretend to be one here. I don't hold any governmental distinctions. I'm simply here to educate you about the methods and the techniques that I've been exposed to over my 12 plus years in the coaching and training side of this business. And I'm going to show you a method that I use and I love. But as with everything, I encourage you to do your own due diligence before you make any kind of a decision. The bottom line is this: trading involves risk. You should never trade with money you cannot afford to lose. And again, I'm sure you've heard that over and over today. Also, any results that are shown, whether they're real results that someone has done or they're hypothetical results, either way, those things are never a guarantee of future results. Someone can predict the future. So hope that's clear enough. I know I'm rehashing things you've already seen. We're all adults here. We're responsible for our own actions. So let's just go ahead and keep this thing rolling. Now, many traders, when they're coming into the market, they look at it in different ways. Some look for patterns. They look at pattern recognition. Some use multiple indicators and through technical analysis. Others are really heavily reliant on fundamental analysis. Again, nothing wrong with any of those trading plans. Folks use them, apply them very, very effectively. For me, as I mentioned earlier, not so much. I've tried them all. The one that has consistently provided me with consistency is what I'm going to share with you today. I mean, here's the thing. For me, looking at patterns, it seemed great on the onset, but then as I dug into it, I could only really find them in hindsight. When I was watching the hard right edge, I personally found it tough to interpret, and I found it to be very subjective. Fundamental analysis is another thing. That one just frustrates the heck out of me. It always puts that Keynes quote into perspective, right? The markets can be irrational for longer than you can be solvent. It drives me batty to clearly see that an instrument, doing air quotes over here, should be doing something, but it isn't. So again, I found that to be fairly subjective, and it really didn't fit my personality. Technical analysis is what really spoke to me. Even that, though, if you put too many filters onto a chart, it could become fairly confusing. So that led me over time to just simplify, just strip things down and really get down to the basics. So I realized ultimately with any of these methods that my odds are still 50-50 once I click the button, right? Once you click the button, all the analysis in the world that you've done doesn't change what happens after you click the button. It's going to go up or it's going to go down. You stop and let that sink in for a minute. All the analysis in the world doesn't change what happens after you click the button. You're not in control anymore once you click the button. And once you accept that truth, truly accept it, you get this kind of calm washes over you. So, just stop complicating your life and just simplify it, right? We have this tendency as human beings to really want to make things way more complicated than they need to be. So stop it, stop complicating the stuff. It's really important to your success, I believe, because unfortunately, and I'm sure you've heard this already today, 98% of traders fail. It's a fact. It's unfortunate, and it's totally avoidable. That's probably the most frustrating part as an educator, is it's so avoidable for traders. And unfortunately, I think those failures are driven by the resistance to just make 1 or 2 small adjustments that could totally change their futures, right? And now, with the recent epidemic, the number of new online traders has increased exponentially, and they're getting their dang trading ideas from TikTok and other social media outlets. Often the blind leading the blind. So, coming back to this event, thank goodness for traders and educators like the ones that are here that can provide some real value and some real direction. I've been active in this industry mainly as the back end support for educators and traders. I've been the guy that's doing the fulfillment and really talking people through how to get results. I've been doing that for 12 years. Most of the folks that I've had the opportunity to learn from are actually speaking at this event. Some have been around a little longer, and they're a great group of educators. I'm going to stop gushing about the event, but anyway, you're going to see that there's a lot to learn, and educated traders have an advantage. They don't have an advantage because they know more about the intricacies of the market. They don't necessarily have any insider information. They've got an advantage because they think differently. And that's what I want you guys to start doing a little bit, is just thinking differently about how you approach the market. They think differently from most retail traders. And I'm going to spare you that soapbox speech of mindset, but I will say it's the difference between long-term success and the traders that just flame out and crater their accounts in a couple of months. Thinking differently about the market is what allows them to put the odds in their favor in this zero-sum game, right? The winners are paid for by the losers. The losers pay for the winner's lifestyle. So you've got to find an edge, and you've got to use it consistently to be in this business for the long term. So how do we do that? How do we find that edge? Well, that's what we're going to do. And today, in the next 40 minutes or so, we're going to talk about a simple strategy, and you're going to learn how to easily identify the directional bias for any instrument you're trading, whatever it might be. And then you're going to learn a 3-step trade process, and we're going to break that down step by step, because the 3 steps are pretty broad, right? And then at the end, I'm going to show you how you can get access to an amazing indicator that'll give you some exact trade entry and trade exit ideas. And then I might even sprinkle in some just sage advice I've learned over the years, right? So this is me. That's me and my family, actually. Many of you that are watching this might already have a relationship with me. You might know a little bit about me because you've heard me speak before. For those that don't, you might be going, who's this guy that's teaching you this stuff, right? Well, first and foremost, I'm a father and I'm a husband. I've designed my life around doing things that I enjoy doing. My family and I love to travel, as Jeanette said. We've lived all across the U.S., from Nevada to Florida and places in between. And we've actually lived in 2 countries outside of the U.S. We lived in Costa Rica for a couple of years. Lived in Argentina for a year. We travel regularly, or we did. We traveled almost monthly until the world shut down. We were actually in Costa Rica when the borders started closing down in March and had to come back. We've enjoyed visits, some extensive, some short, through 28 countries in the past few years. As a matter of fact, for a 5-year period, we were essentially homeless. We just traveled from place to place. My son, my wife, and I had 3 big suitcases with our belongings. And if we liked somewhere, we'd stay until our visa ran out, maybe even renew it for another stay. If we didn't, we'd just move on pretty quickly. And, we now live in Texas. We've moved here a little bit ago, and kind of putting down some roots here in the DFW area. My wife and I both have family and close friends in the area, so it's a good spot to ride out COVID and put down some roots, I guess. Ultimately, all made possible by being able to work with my laptop in the financial niche. So that's the cool thing about this business. All you need is a laptop and an internet connection. Since 2008, I've been working with traders to help them find a path to success. And as I mentioned, generally on the back end of the different coaching programs, right? With trading, it can be a complex game. It looks super, super simple on the outside. Yet when we start learning and start practicing, we find out that there's something missing, right? 1 + 2 should be 3. If A happens and B happens, then C should come next. But it doesn't work that way with trading. There's always some other variables that work themselves in there. And then, it turns out that there are other answers to what seemed like should be such a simple equation. And it leads us to start asking questions like, what am I missing? What don't I know? What do they know that I don't? What do they know? What are they doing that I'm not doing? Those elusive theys. you know, in your frustration, you've probably been wondering those things. I know I did. I'm going to give you just a quick example of how my trading started out, and then we'll keep this thing rolling, because this is pretty much an actual photo of what the market did to me when I first started trading. It was not pretty. I started out in probably the worst way possible. And I don't usually talk about this. I usually just begin from where it got good. Anyway, I started out like this. I went to a big arena style event, and those were really popular in the late 90s, early 2000s, mid 2000s. I'm sure you guys have seen them. They'd put 10 or 20,000 people in a stadium or an arena, and they'd bring in some super big names to give motivational talks like Schwarzenegger and Giuliani and whatnot. And then in between those big headliners, they'd have these folks giving pitches in the middle. And anyway, I started by like this. I heard a pitch for this amazing red light, green light software. It was going to change my life. Sounded great. I paid some absurd price, took it home, didn't bother to do the training. Who needs training, right? I put 10K in an account and I just sent it. First trade, bang, big win. Wow. Oh my God, that was so easy. But I didn't learn anything. I didn't learn about how the system worked. I didn't learn about what edge it created. I didn't learn about how to size my trades. I didn't learn about how to manage stops. I didn't learn about how to manage the trade once I was in it. I didn't learn about how to set targets, any of those things that are really, really important, as you know, as traders. All I had to do was fire up this software, find a signal, make money. Well, obviously, you can guess where that went pretty shortly after that. The thing is, I had a taste of success. It was a small taste, but it was a taste. And now I was hooked. And I had seen that it was possible. I just needed to learn a little bit more. And luckily, people share. And sometimes they share great information. So I started learning. I learned about odds and probabilities, learned about risk management, proper trading mindset, different types of analysis, so on and so forth. And then as I started learning, I started to raise my hand and offer to provide support to those folks that I'd been learning from. And in doing this, I got the ability to speak with other traders, which allowed me to see that most traders were facing the exact same challenges, different face, different name, same problems. And then through that, I learned what it takes to help folks get on that path to success. So what I've learned over time is this. Again, I went full-time into doing this in 2008, and I've been working with traders ever since. And I figured out you don't need to have a lot of experience to be a successful trader. You really don't. I know that can be argued both ways sometimes, but you don't. Simple strategies do work, but you've got to work the simple strategy. And that's where most people fail with it, is they fail to actually work that simple strategy. They keep trying to overcomplicate the damn thing. Sorry, I didn't mean to curse on that. Markets are fairly random, but an edge truly can be found. And exploiting that edge with good money management is what leads to trading success. And then also, psychology of trading is what will turn any good system into a bad system really quickly. At the end of the day, it is all easier said than done, really because of the psychology of it. We just want to find a simple plan that gives us an edge. So how do we do it? I know you're going, Brian, come on, get on with this stuff. How do I do it? Well, let's start here. When you sit down to trade, you look at a chart, right? Just a bare basic chart. You find an instrument you want to trade. Maybe you throw on some trend lines, you throw on some moving averages, maybe you use a MACD or support or resistance or Fibonacci's or Ichimoku cloud, whatever. Any indicator you like, it doesn't matter. They're just filters. They're just filters that allow you to view the market in a certain way. All you really want to know when you look at that chart and you put those filters on there is, where's price going next? What's the trend? Where should I enter, right? If I do enter, where should I exit? Most people are going to look at this and they're going to find some learned chart pattern, which again, easy to see in hindsight, tough to identify when you're on the hard right edge, for me anyway. You might add a bunch of other indicators in hopes of gaining some hindsight. Thing is, none of those things work consistently and are actually a bit subjective, and the subjectivity of it is what makes the trading process tough to follow and often tough to stick with over the long run. So I use a system that's a discretionary trading system that's still, it's very rules-based. You know, rules-based, that matters a lot. Takes the guesswork out of it, takes the guesswork out of the trading, and it reduces that subjectivity of finding the direction and the entry point. So just think about it for a second. What if you could reduce your time staring at the charts and analyzing those charts? If you could time your entry to better maximize the returns and limit the risk? What if you could increase your trading accuracy? That would probably help a lot, right? Remove the subjectivity from the markets and trade based on quantifiable data. Do you think that would make things easier? Yeah, of course it would. It's a rhetorical question. So you guessed it. You can do those things when you follow the method that I'm going to show you here in a minute, which is, as I told you before, on the high level, really simple. Identify the trend, wait for a pullback, enter on a break at the key area. And I'm going, dude, Brian, those are crazy broad steps. We're going to break it down in a minute. We're going to break it down. Stick with me here. I'm a fan of following the trend. So the first step is to identify the trend. Why? Why do I care about the trend? Because an object in motion tends to stay in motion until acted on by another force. Yeah, I just quoted Newton's law in a trading talk, but that law applies to trading just as much as it does in physics, right? Next, we're going to wait for a pullback so that we can enter with a bit of a discount on our position. And then we wait for our trade to break through a specified level to get in. That's simple. I know, that's too simple. What's the catch? We're going to dive into that right now. I just want you to keep in mind, simple is great. Don't overcomplicate something that doesn't need a complicated solution. Simple plans work because they're simple, and because they're simple, we have a better chance of understanding them, which leads to a better chance of sticking to it. And I'm emphasizing the sticking to it because that's where most traders fail. They cut and run the second they've got a couple of losses in a row, and that's the wrong thing to think about. We'll get into more about that later. I talk about that a lot in my daily live updates that I do. But yeah, there is more to it. There's even a trick that allows us to put the momentum into our favor. So let's dig into each step. So first thing, we're going to identify that trend. We need to figure out what direction this thing's going. And you know, knowing what that daily bias is, knowing what the intraday bias is that we're going to trade on, helps us to determine what direction, if any, we want to trade for that day, right? Now, wait a minute. You're going, Brian, you just said if any. Well, yeah, there's going to be days we don't trade, and you're going to understand more about that in a second. So why do we want to know what the bias is? Well, I mentioned Newton's law earlier, an object in motion. Think of the market like a freight train, right? It's a big freight train. It's moving in a certain direction. We want to go in the direction that train is moving. We just want to hop on and go for a ride. We don't want to jump out in front of the train and hope that it stops, right? Now, don't get me wrong. There's merit in counter trend trading as long as you've got a solid plan, but that's a discussion for an entirely other training session, counter trend trading, right? Today, we're going to focus on trading with the trend because I feel like that's the easiest way for traders to get on that path to success is to trade with the trend. That's the easiest way to get started. Once you get consistent, once you get successful, then you can add some tweaks to it. So let's keep it simple to start with. Trend trading has been proven to be successful, very successful, and it's proven to be pretty easy to follow too. The challenge is, how do you actually do it? How do you actually find the trend? So if you look up trend trading, you're going to find a ton of different ways to identify that bias. You know, if you Google it, you'll find, as many ways to look at trends as there are people out there. Again, there's no right or wrong. There's just different ways of approaching it. The way I do it is this. First, I apply 2 moving averages to my chart. One's a short-term moving average, or you might call it a fast moving average, and the other is a longer term moving average or a slow moving average. So for the short term or the fast moving average, I set it to 20 periods. For the long term, I set it to 100. Green and red. The short term is green, long term is red. So if the 20 is above the 100, the short term is above the longer term, I consider that to be a long bias. If the 20 is below the 100, I consider that to be a short bias. So next, I just look at that bias on multiple time frames to see if those time frames are in agreement. So if I'm trading a 30-minute chart, for example, I might check that bias on a 4-hour, and then I confirm it on a 30-minute, because I only want to trade when they're both in the same direction. I want to make sure that freight train's moving in that one direction. I don't want to, jump out when that engineer's trying to figure out, hey, am I going to stop at this station, or am I going to keep on trucking here, right? And by the way, it's important to know when not to trade. It's like that Kenny Rogers song, you got to know when to hold them. So this tells us when to trade. If they're mixed, it tells us don't trade. So that's a big deal. So once we've determined our bias, once we know what direction we want to trade, then we start looking for an entry. And with a lot of trend following systems, you're going to trade from just straight breakout points. And often this is just like a recent top or a recent bottom, depending on the direction that you're going. But I like to get things at a bit of a discount. I'm sure you do too, right? Everyone wants a discount on something. So I'd rather find the trend and then get in at a better price to give myself more potential upside. So, we know markets don't just go in one direction. Even when there's a solid uptrend, there's going to be times when the market moves down. And if there's a good solid downtrend, there's going to be times when we have opportunities to go, where it pulls back and it goes long during that downtrend. So to get the best entry, we wait for the market to pull back from its intraday trend. So if the market bias is long, we'd wait for the market to start making lower highs and lower lows, like in the box over here. And then when we can see that we've, when it's moving its bias and starts making those lower highs and lower lows, we wait and then enter on the break of a previously closed lower high. It's pretty darn easy. And if it were going the opposite direction, if it were going down, we'd be looking for it to make higher lows and higher highs, right? And we just, put our entry point at the top of that previously closed candle, and then wait for price to return back to its trend, break through that, and then we ride it out for potential profit. Now, just a quick caveat here. You want to look at this during regular trading hours when volume and potential volatility is at its highest for that instrument that you're trading. All things aren't created equal, right? Different markets, and if you're trading Forex, for example, on the pound versus the CAD, you might have more volatility during the beginning of the London session than you would at some point, random point in the day, right? So we want to think of this around regular trading hours. We'll get more to that in just a second and kind of hammer that home. But let's look at some examples, because I know that the lead up to that was pretty lengthy and it took me 5 minutes to teach it, right? So let's dig into some examples and really show you how this works so that you can follow along with that process, all right? So let's start with the S&P. Here trading one contract on the ES, on the S&P E-minis, you could have seen a potential $1,000 profit on $275 of risk. So let's walk through the trade, because first, what we're going to do is we're going to look and see what's our bias. What direction is this going right here? Well, I see we've got a long bias. Why is it a long bias? I know that because the green line is above the red line. Right? I'm keeping it as simple as I possibly can. I don't want to overcomplicate my life. I can see the fast moving average is above the slow moving average. And even though it looks like the market might be a little bit flat over here on the left leading up to this, I'm not worried about it. I'm looking at something that's quantifiable. The red line is below the green line. The green's above the red. The fast is above the red. As long as it's there, even if it's converging, as long as the green's above the red, that tells me I've got a long bias. I'm not going to overthink it, right? Next, we wait for the regular market session to begin, because again, we want to trade during times of higher volume and potential higher volatility. So we wait and we see if we have a pullback that meets our criteria, where we start making lower highs and lower lows. So we wait for the market to start pulling back, lower high, lower low. And then we enter on a break of that previously closed candle that had the lower high and a lower low. Enter on that break, and then boom, we're able to ride that out and into potential profit. It's pretty easy, right? Don't overcomplicate it, don't overthink it. If these lines crossed ahead of that, then I wouldn't have a trade. because my 4-hour bias would be different from my 30-minute bias, and I wouldn't have a trade. They've got to be both going in the same direction, right? Here's another example. This is gold, right? One mini contract on gold, generated potential profit of 1750 on 550 of risk. Yeah, I'd take that risk versus reward any day. So can you spot the entry on this one? It's the exact same process. We first check our directional bias. So is the green over the red? Again, it's not subjective at all. It's very definitive. Is the green over the red? I don't care if it's flat like it has leading up to this point. I just want to know if the green's over the red. And of course, it needs to be the same on that 4-hour time frame as well to confirm our bias. If they're mixed, we're not going to trade it. Then we wait for regular trading hours to begin and start watching to see if we get lower highs and lower lows, which is in the, if we're in a long, looking for long opportunities, we want the market to pull back, making lower highs and lower lows. And then we would enter on the break of that previously closed lower high, and then boom, ride it out for potential profit. Now, I don't know how it could be any easier. I mean, we're trading in the direction of the trend. We have a quantifiable way to measure the direction that we want to trade, right? We can identify that trend. We use a breakout in the direction of the trend that uses limited risk. So in the event that price continues to move down or continues to move counter trend, we either don't trade, or if we're in one, we get taken out pretty quickly. But then when price does move, we give ourselves the opportunity to bank 2x, 3x on our initial risk. And as a quick side note to that, by the way, having wins that are 2 to 3 times our initial maximum risk, mathematically, that allows us to be profitable even if you have a win percentage that's less than 50%. So let that sink in too. I'm sure you've done the math on that before, but you can do worse than a coin flip and you can still make money in the market. So let that sink in for a second over there. The question usually, because I talked about 2 futures trades, so I'm going to throw in some stock stuff here, because the question usually at this point is, well, Brian, that's awesome. I don't trade futures though. What about using this method on Forex or stocks or ETFs? Does that method work there? Yeah, it does. I mean, to me, the sign of a good trading plan is that it should work universally with just some small adjustments. And what adjustments am I talking about? Well, adjustments to the time of day that you're trading, depending on when that instrument that you're looking at is most active. Looking at some adjustments around how you might trail your stops, or maybe use fixed entries, or is the profit target appropriate for the instrument that you're trading? It's small adjustments, right? But overall, the plan itself should work no matter what you're trading it on, if it's a solid plan. We're not building some complex model that has to be curve fitted to a specific instrument. We're just using simple stuff: market trend, breakout momentum, and basic math, winning a little more than we lose. And then all that stacks up together to create an edge, right? So yeah, this works in other instruments that are out there. So check it out on a stock. I mean, here's Amazon, 30 points of risk with a 61-point return. Exact same process. First we go in here, we check out the moving averages. I don't know why that bottom one's cut off down here, but it is. We check out the moving averages to see if we've got the fast moving average above the slow moving averages, my green line above my red line, basically, right? Then during regular trading hours, we watch for price to start pulling back and making lower highs and lower lows. And then we trade on the breakout of that previously closed lower high. It's that easy, boom. It's rules-based discretionary trading. It takes the guesswork out of the equation and it gives you an edge. And in doing that, it lets you regain your freedom from just staring at charts and guessing, right? It does a lot of things for you, I think, beyond just giving you some semblance of a way to approach the market consistently. Here's another example, just throw it on the SPY ETF, 375% potential return on risk. Exact same process. Oop, I don't know what I just clicked there. There we go. Exact same process here. We just go in and we see, what's happening. Where is my directional bias? Is it long or is it short? I wait for the pullback, and then I enter on a break. And that's it. Boom. Everything else does it. It moves on and takes us out. If it kept moving down, we either A, wouldn't have an entry because it wouldn't have broken through, or if it did enter a move against us, we're going to have a pretty tight stop in order to take that out, right? Back over to indexes. Let's look at this one on the NASDAQ, on the NQ. Single contract here, you could have had a potential risk of about a little over $500 to see a reward of over 2,600, right? Again, same exact process. It's all about consistency. What are we looking for first? Number one, confirmation of directional bias on multiple time frames. So we want to see that we've got long bias on multiple time frames that we're watching at. Again, I'm not concerned about whether the lines are trending up or trending down. I'm not worried about the fact that they seem to be converging on one another. I only care if they cross. If it crosses and it's crossed, then I've got a conflicting bias. One might be different from the other, and you don't trade it. Don't read more into it than you need to, right? Keep it simple. And I'll get to questions once I finish this. I said I was going to minimize chat, not look at chat, but when I moved my screen, chat popped back up, and now I'm getting distracted where I might start tripping over myself. So I'm going to keep moving. I'll get to your questions at the end, so you'll know exactly what those moving averages are. Again, I said them earlier, but I'll go back over it here in just a bit. So, we're looking to see what's happening here. Again, not subjective at all. Very definitive. I don't care about what's happening with convergence on this at all. I just want to know, is it above, one above the other, and if they cross, that throws me into a situation where I've got a conflicting bias. Next, I'm waiting during regular trading hours. I want to see price making lower highs and lower lows, and then I want to enter on a break of that previously closed lower high, and then ride it out for potential profit. And that's pretty much all there is to it. It's super, super simple. Now, on most of my examples, by the way, you might have noticed that I've been using a trailing stop. I don't know if it's been evident, but you might have seen the fact that I've got a trailing stop here. There are pros and cons to using a trailing stop. Some traders prefer a fixed risk and a fixed reward point, fixed stop loss with a fixed take profit point. As I mentioned at the very beginning of the presentation, there's no right or wrong to this. It really comes down to two things when you're looking at your trading plan. First is, A, do you have something that you're comfortable with that fits your risk tolerance and your trading personality? And then B, does it make sense mathematically? That's all you really have to know. Just because one person uses a trailing stop doesn't mean it's the best for you. Your personality may, you may want those big 2x, 3x wins all the time versus having trades that move in your favor and then get stopped out as price makes a minor pullback and then continues without you. That might make you more crazy than just taking a full loss and then having opportunities where you take a full win. There's no right or wrong. The challenge is often the second part of that piece, right? Which is, does it make sense mathematically? And you may not know the answer to that until you do some testing. Ultimately, it's always important to test, both back test and forward test a method before you start putting real money on the line. You've got to know what to expect. You've got to understand your potential drawdown. You've got to understand your risk to reward. You should know your win percentage. All those things come into play, and all of that's really necessary in order to set yourself up to have the right mindset to be able to stick with the plan. Because if you don't have a clear understanding of your plan and the expectations around it, then the first series of losses that you have, and by the way, any trading system, every trading system is going to have a series of losses. You're going to just jump ship and run to the next. It's that shiny object syndrome. Bah, this doesn't work. I'm out. Even though if you had back tested and even forward tested for a while using plain money and had a good understanding of how that method might work, you might go, it's totally realistic to have 6 losses in a row, but those 6 losses are tiny losses compared to the wins that I have. And you'd understand it. So when you got those 6 losses in a row, on loss 6, you wouldn't just go, bah, I'm done, throw your hands up, throw the laptop at the wall and it bounced, right? Anyway, yeah, I'm kind of going down a rabbit hole. So let's get back to this. I've obviously shown you trades where it all works wonderfully, right? why would I show you anything else? The thing is, it doesn't always work. The method does not always work. No system ever in the history of ever is going to give you a 100% win rate. The key is to have wins that outweigh your losses, like I just mentioned a second ago, right? Sometimes you're going to get situations like this. Sometimes you've got a nice upward bias. You've got a great upward trend, right? You wait for price to start pulling back, and you enter on a breakout of that previously closed lower high. Enter on that breakout. Price kind of moves in your favor for a minute and then falls off a cliff, right? That happens. That's just part of trading. But what you'll also notice is that, before, I were able to trail that stop up and took a much smaller loss, almost a break-even trade here, before it actually moved all the way down and would have taken out. The key is to put the odds in your favor, and you can do that just simply mathematically by having some sort of a quantifiable process-driven system that gives you the ability to lose less than you win. Maybe not lose less times, but lose less money than when you win, right? And there's also way more ways that we can stack the odds even more in our favor, and we'll get to that in just a second. But just by using the basics that we've talked about right now, I think by now you can see how it already gives you an edge. Something like this super simple system gives you an edge. And let's look at one more example. One more quick example here, because up to now, all of my examples that I've shown had been on long trades, just a facet of the market right now. But here's one in a short position. So I just wanted to bring it up and show it through. The process is exactly the same. But in this one, we have a short bias. How do I know we have a short bias? Super easy to see. We've got the green lines below the red line. My fast EMA, or my fast moving average, is below my slower moving average up here. That's it. Now we're going to look for the market to make higher lows and higher highs. So higher lows and higher highs as just an exact opposite of what we were doing in a long market, right? That's all of this. Then we wait for the regular trading session to begin. We wait for price to start making those higher lows and higher highs. And then we just enter on the break of that previously closed higher low. And then boom, write it on down. That's it. If price kept moving up against us, we wouldn't enter the trade because it wouldn't have come back to touch us in on that. So, again, that comes back to the know when to hold them, right? We got to know when not to trade. So how can you get a bigger edge with it? I think the process itself is super, super easy. How do you make it better, right? We've just talked about the 3 simple steps to get in, but you can do more with it. The entry, I think most of you are fairly experienced traders that are on here. So, the entry is only part of the equation. How do we manage the trade over the long term? That's what becomes the key to success, is how you manage the trade. As with the right mindset, which I've mentioned before. I can't say something about long term and not talk about mindset. Anyway, we've got that basic, easy to follow trading method. Puts the edge in our favor just by following the trend and using a quantifiable method for judging that trend and our entry point. But then, we can use the employment of additional time frames to further dial in that entry process, which I talk about quite a bit in our live sessions. Some traders like to use key support and resistance levels to further time those entries. So what I mean by that is as opposed to taking that, price starts to pull back and maybe it starts to bounce up again, as opposed to just taking that first bounce back up, they may wait and see if price pulls all the way back to a key level before they start looking for that entry point on the top of the previous candle, adding a little bit more of a filter to it, right? It's just filters. It also means you trade less when you do that. But some traders may want to do that. You could use RSI with it. You could add Fibonacci's. You could add other indicators in conjunction with the strategy, just to put on the filters that are going to make you more comfortable and more confident, right? Do keep in mind, though, that the more filters you add to something, the more you complicate the strategy. And also, I've kind of found out in time of talking with traders, generally, the reason that traders start adding more filters to something is hopes of creating I'm doing air quotes here, perfect strategy that somehow guarantees them an outcome. Trading is a game of risk. There is no guarantee. There is no guaranteed outcome. And you're never going to be successful in trading until you accept that. I just want to be blunt with you on that piece of it. So that's something we have to accept. To manage our trades, well and stack the odds in our favor even further, we can start considering maximum risk size. A lot of traders don't always know how to size their positions appropriately to their account size. So there's some great tools that can be utilized for that if you don't already know how to calculate your position size based on your account. We share those in our live sessions. Also, talking about stops, how we utilize the stop loss and take profit points. Making changes to that process, not on the fly, but making changes based on the instrument that you're trading, obviously is going to have an impact as well. Stop loss placement plays, I'm tripping on my words there, it plays into that max risk number, but it should always be based on something that's quantifiable and is relevant to that instrument that we're trading. I very often hear folks in the futures market talking about these static stop loss points. I'm going to use a 5-point stop loss. Well, that's great, maybe in the S&P, but it's nothing in something that's more volatile like the NASDAQ. If you use a 5-point stop in the S&P, you've probably got a little bit of room. You do it in the NASDAQ, you'll get blown out in a minute. So, that's something else to consider that we have to think through and talk through and test, right? And then trading mindset is especially important. And I feel like that's what really makes the difference between sticking to your plan or abandoning that plan after a couple of losses, right? Because the lack of mindset is what leads to the shiny object syndrome, jumping from method to method to method. And that's another thing I've just seen probably way too often is traders not giving anything a fair shake. They just jump ship the second you get a series of losses, which, as I mentioned earlier, is just part of every trading process. Anyway, it's a super, super simple process that can get you on that path to success. As a matter of fact, if you only looked at the 4 trades that we put up on the futures market here, $1,800 of risk to a almost $7,000 reward. That's a 350% return. Not bad for looking at one potential trade per day in a 2-hour window. And I didn't really spend too much time on that, but again, I said it up front. We want to trade during times when we've got the best opportunity for that instrument that we're trading, right? You don't just do this blindly throughout the day. You want to do it at times that it has the best opportunity to be effective. Those are going to be the times that you've got the most activity on that instrument that you're trading, right? So ask yourself, what if you could keep your risks small, take advantage of market momentum, and put the odds in your favor? You know the answer already. You do. Yeah, just by giving yourself a small edge, you can create some huge trading opportunities. Here's the performance of the current contract on the S&P. Would you risk $2,000 to make 11.5? Yeah, I would all day long. I do. I love this strategy. Micro gold. I know a lot of traders ask, well, what about micros? I have a small account. I can't really trade futures. Well, you can, because there's micro futures, depending on what your account size is, obviously. Even micro lots have margin requirements, and you can't go over the moon with it. But there's still a lot of good that can be done trading micros. And what's funny is with gold, the actual quote win rate, which I don't really focus too much on because I care more about winning more than I lose. But the win rate was actually lower on this than it was on the S&P. But here again, with about a 5% drawdown, netted profits of $500 in just a couple months that the contract's been active. Most traders don't see returns like that in a year. E-mini, is this E-mini? What one was this? Yeah, a single E-mini contract, $900 of risk for a potential reward of $9,000. 8% drawdown on a $10,000 account. So up to now, you might be feeling like trading success is fairly elusive. but it absolutely is possible. I've just given you some basics that you can use. We walked through the process. You can use that and get started right now. You absolutely can. In our live market updates and our member training sessions, we really help you understand more about how to make this program your own and design a trading plan that best fits you. Because to me, anybody can try to take a trading plan and learn it, but you're not going to be successful with it until you customize it to yourself. You've got to make the things, you've got to make it work for you, right? You can't just take something and try to shoehorn yourself into it. You're not going to be successful. Your subconscious won't let you, well, it won't accept it, right? So you've got to learn how to make minor tweaks, like, you know, changing the time frames to fit your personality, adding profit targets, or, you know, changing what the profit targets are, figuring out if you're going to use a static or dynamic stop, adding some other indicators on that might make you feel more comfortable. All of those things can work together to improve your results and also create that custom plan that's going to work for you, right? And the big thing is really just to be consistent and to be persistent. So, you know, if you want to learn some more from me on that, you can enroll now. I'm going to put up a link here in a second. So here's the pitch. I told you up front there was a pitch coming. So this is the end. This is all I've got. I'm about to get the hook. So, you know, I'm going to share this with you. There's a link. I think it's in chat. If not, let me just go ahead and post it in here. Where's my, oh, there it is. Yeah, thank you. So, you know, here's what you're going to learn. We've got a pretty cool package. It's only $297 for, you know, what I feel like is some pretty awesome training, if I do say so myself, along with some a pretty cool indicator that comes along with it. I've got a brand new course. We're going to do it live on September 9th at 8 a.m. Eastern. So everybody that joins today actually gets to attend live and in person, and we're going to talk through the strategy. We're going to talk about how to use it on different account sizes. We're going to dig in to how to further dial this thing in on your entry process. We're going to talk about how to add filters so that you can, you know, further define your entries and look for those high probability breakouts. We're going to address the mindset stuff for staying committed. And that's huge because you don't have the opportunity to get those 3x returns if you can't stay committed to your process, right? And then, you know, you're going to learn, honestly, how you can be wrong more than you're right and still make money. Yeah, so just join me. And the indicator, you'll get that lifetime access. It's on TradingView. It gives you an alert to potential entries to take profit points, etc. That's only $297 when you get started today. So hit that link and let's get going with it. I'm going to, again, do this live on September 9th. And the course is pretty much what I already said. You know, it's more about the process, how it works, and importantly, why it works. I just can't stress enough how you've got to understand whether it's how I trade or how someone else trades. You've really got to understand it, truly understand it to have it work for you, right? And then you've got to find out how to make it right for you. So we talk a bit about finding the right market. Find the right market for you to trade. You know, some folks go, I want to trade futures. Okay, great. Why? They don't know why. They have never considered alternatives. They have no idea why they want to trade futures. And maybe the time of day that they're trading and the account size they have isn't right for futures. So let's find something that's right for you and get you trading that, find success, and then move on over, right? It's going to be an awesome course. It's going to help you understand trading in depth and give you those odds for success. So, you know, go ahead, TradeWithSmarts/breakout, get started right now. And, you know, I haven't really gone into detail at all about the indicator, and I'm about to get the hook, so I'm gonna get off here. Someone asked why TradingView. TradingView because I love it. I'm a Mac guy, and you know, quite honestly, trade stuff is not made for Macs. And you know, if you're with TradingView, you can go in, you can set up your charts, you can set up your indicators, you can add some strategies to it. And if I log in on my PC, it's there. If I log in on my Mac, the charts are there. If I log in on a tablet, it's all there. I don't have to set anything up or download anything. It's there on the fly. It's a beautiful program. I absolutely love it. Real quickly, Raleigh, I know you're on, and I see the hook. I can see it coming.
No, we're doing good.
A couple of really quick things here. Let me see if I can get this off of here.
We got 3 minutes. Take some questions. We're on time.
I'm running through them. What moving averages am I using? So the moving averages I use are 20 and 100. So my fast moving average is a 20, and my slow moving average is a 100. Why 20 and 100? That's what I want to see when I'm looking at the market. Some people do this exact same strategy. They use faster moving averages. They want to get into more trades. They want to have more trading opportunities. So the tighter you make those bands, the quicker they are to flip on one another, and the quicker they are to give you different opportunities to enter, more frequent opportunities to enter. There are days when I don't trade. There might be multiple days in a row where I don't trade simply because my bias hasn't set up the right way, or I just simply haven't gotten a signal during the time that I'm in. So we dig more into that in the live training. But the moving averages that I've got there are the 20 and the 100. More about setting up stop losses. That's a great question. That's something kind of for its own session to talk about stop losses. But I use a trailing stop, and I don't use it based on a static number, although you could. I use a trailing stop based on the previously closed candle. So as something starts moving, I'm trailing my stop based on that previously closed candle to give it an opportunity to move. I found that for me to be effective because it takes into account that instrument that I'm trading and kind of its range. And then B, it gives that opportunity as something really takes off to ride it out for that longer term. But there's pros and cons. Like, trading is truly trading. There's a trade-off with everything you do. When you use a trailing stop, you don't always have trades that run the full breadth up to maybe your take profit point. When you're using a trailing stop, you're getting stopped out as the market ebbs and flows. But for me, it takes off risk a little bit quicker. So I'm able to more frequently ratchet off risk into very small losses or break-even trades, and which over time, as you get those big winners, it gives my overall win versus loss the ability to have greater wins than losses, which mathematically is what we need over the long term to see that trading success. So there you go. And you can see the hard right edge right now, by the way, on a couple of trades that are still moving right over here. This is an S&P trade that's on and moving, and you can see a NASDAQ trade that, on and actually was been stopped out back here. So.
Well, I tell you what, Brian, I want to thank you so much for a terrific presentation. It felt to me like that hour just blew by pretty quickly.
It felt like that to me too.
Thank you,
anyway,
Brian.
yeah, thank you for pulling all that together and giving that presentation. And folks, you can see here on Brian's slide, the breakout indicator, the lifetime access to the BTX indicator, live trading, full access to the recorded strategies. Go to tradewithsmarts.com/breakout and take advantage of that offer. Just, Jeanette, a couple of things that I noted here in his presentation that kind of resonated with me, and I think this holds true for everything. I mean, taking the emotion out of trading is extremely important, and eliminating complexity, keeping things, as he talks about, consistent and be persistent, keep things simple, follow the trend, money management, lot sizing. These are just good things that we all should have as traders, because regardless of what technique and approach that you take, you've got to get rid of that fear and greed. You've got to get rid of that emotion, and having, a system that you're comfortable with, that you can be consistent with is really, I believe is one of the most important things. And I know Johnny's going to talk a little bit about that as well, but I really appreciated the way that Brian emphasized that point. And keeping things simple, what about a quiz?